Assuming you're thinking about your home loan choices while making your home purchasing plans, one choice to consider is a flexible rate home loan, or ARM, which can offer the two benefits and downsides for potential homebuyers. An movable rate contract has a loan cost that isn't fixed, however is dependent upon future developments at customary stretches during the existence of the advance, says Greg McBride, boss monetary investigator with Bankrate. While gauging your choices, here's what specialists say to consider. As per Holden Lewis, home and home loan master at NerdWallet, an ARM's early-on financing cost is normally lower than the rate on an equivalent fixed-rate contract. The lower financing cost implies the regularly scheduled installments are lower for a given credit sum, which makes homes more reasonable. It likewise implies that purchasers can utilize an ARM to stretch and purchase a house that they couldn't bear with a fixed-rate loan. What are the dangers of an ARM? Lewis tells Fox Business that the greatest gamble of an ARM is that the loan fee could ascend beyond where the regularly scheduled installments are effectively reasonable. ARMs begin with a basic loan cost, and most ARMs can climb 5 focuses higher than that early-on rate. So an ARM could begin with a basic pace of 6%, with the chance of rising 5 rate focuses to 11%. It's difficult to decide how likely it is that an ARM could arrive at its most noteworthy conceivable loan fee, he says. Is an ARM the best decision for you? An ARM may be a reasonable decision, says Lewis, while you're purchasing a house that you will not claim for a really long time. For instance, on the off chance that you think you'll move inside 5 or 6 years, you could decide to get a 5-year ARM, with a basic rate that endures 5 years, Lewis makes sense of. Specialists insulted over Biden's new home loan rule rebuffing purchases with great credit, a catastrophe waiting to happen. One more situation that might be a fit for an ARM is for purchasers who anticipate that their earnings should rise significantly. An exemplary model is somebody in a clinical residency program whose pay will go far up in a couple of years after they complete their residency program, Lewis says. Proficient competitors and individuals in the big time could expect large expansions in pay, as well, he adds. And at last, somebody who expects a monetary bonus could choose an ARM fully intent on taking care of the home loan when the cash drop occurs, Lewis says. How does the market influence the rates for customizable rates? Does expansion influence it? ARMs are connected to a file called the Got for the Time Being Funding Rate, or SOFR. The SOFR record answers hoard market influences, including the expansion rate and the government subsidizes rate, makes sense of Lewis. The 30-day normal SOFR, which ARM rates are filed to, has gone up around 4.77 rate focuses starting from the start of 2022, and the government subsidizes rate has gone up 4.75 rate focuses simultaneously, Lewis says. Does it matter the length of the advance? Lewis says a 5-year ARM's early-on loan fee endures 5 years, and a 7-year ARM and 10-year ARM have starting rates that last 7 and 10 years, separately. The more years, the higher the rate, he makes sense of. Borrowers consider this. For instance, to stay away from rate changes and they intend to reside in the house for quite a long time, they would favor a 7-year ARM north of a 5-year ARM. Is an ARM ideal for you? As noted, there are upsides and downsides of picking an ARM. Your loan specialist ought to have the option to respond to your different kinds of feedback and lead you through the loaning system. Yet, knowing the upsides and downsides is vital to making an educated decision. The principal risk with an ARM credit is the vulnerability of where rates will be at season of change, makes sense of Tony Klintic, public retail project lead at US Bank Home Loaning who is situated in New Jersey. The rate could change every year after the decent rate segment yet has limits on yearly changes and lifetime changes, which to some degree limits openness. He says most loan specialists offer a 2% yearly cap and a 5% lifetime cap with the underlying rate being the beginning point, but a lower basic rate can offer benefits for the borrower. With a customizable rate contract, the borrower bears a portion of the gamble of increasing financing costs, and less gamble is borne by the bank or financial backer that claims the credit, says McBride. The underlying rate will in general be lower than it would be with a fixed-rate contract where